Welcome to Wealth Resources Group 2015 State of the Market Update. Hi, I'm Neil Frankel. I'm a certified financial planner. I'm delighted that you're sharing a little time with me. I'm going to spend about 35 minutes today, and I'm going to give you a market update of what's happening and some of the positive things that are happening in our economy and some of the things that aren't so positive in our economy, as well as those forces outside of the United States, international forces. And this isn't the idea is not to try to predict what's going to happen in the stock market, more to try to understand events as they unfold. Just like if you were in a room and you heard a noise in the corner and the lights were out, it might be very frightening, but if the lights were on, it wouldn't be quite as bad because you saw what was happening. So that's the idea. Of course, we can't predict all the different events that may unfold in the 12 months ahead of us, but we can take a look at many of those forces that are impacting our stock market and our economy. So let's take a look. This is a chart that shows the S&P 500 over the last 12, 13 years, and we can see that after the market crashed, after the tech bubble, the market started rising, and starting in the end of 2002, and did quite well over the long run through 2008. And then, of course, we had the financial crisis where the market dropped 57%, and it really took a hit. And after the tech bubble or the tech crash of 2003 and the financial crisis of 2008, many people were sick and tired of the stock market as an investment, and as a result, they just pulled out completely, never to go back. And of course, that would be a shame because, as we can see here, the market did quite well in the years that followed. Okay, so the takeaway here is that, unfortunately, it's par for the course. The market has this roller coaster effect, but you need to think about it long term. Now, what are one of the ways that we can measure risk in the market? Well, it's PE. What is PE? Price to earnings. So if you took a stock, for example, that's going for $100 a share, and it was earning $50 a share per year, that's not the dividend, but how much the company's earning. Of course, sometimes the companies hold on to their earnings, sometimes they pay it out, sometimes they reinvest, whatever. But if the company was earning $50 a share, it would only take, if we do 100 divided by 50, we get a PE ratio of 2. That means it would only take 2 years of earnings to pay for that stock, which is very inexpensive. Think about it. If you could buy a rental house for $100,000 and you could rent it out for $50,000 a year, it would only take 2 years to pay for that house. So that's very, very inexpensive. And here the PE ratio in this example is 2. And it's also very, very inexpensive. And the reason it's very inexpensive is because investors are very pessimistic. They think earnings are going to decrease. They think the market's going to go down. They're not in a very good mood. If the price of a stock is $100 a share, but it's only earning $5 a share, of course, the PE ratio is 20. And that means it takes 20 years for the stock to pay for itself. And that's because people are very optimistic. So just to give you a rough or a perspective on it, right before the tech bubble burst, the PE ratio of the market, the S&P 500, was 24. People were extremely optimistic. And after the financial crisis, at the bottom of the financial crisis, the PE ratio dropped down to 10 because people were extremely pessimistic. So we look at the PE ratio both of individual stocks and the overall market. Right now, the PE ratio of the S&P 500 is 16.2. And the average has been 15.5. So this is actually a point of concern for me because we're a little bit more expensive. The stock prices, we need more earnings out of these companies in order to justify the high stock prices. And it's a concern I have. So let's take a look and see if what corporate America is earning and how they're doing. So This chart shows you what the earnings of the S&P 500 were per share. Back right before the financial crisis, the earnings were about $24.06, which was an all-time high. Then, after the financial crisis hit, the earnings disappeared. As a matter of fact, the average stock lost 9 cents. The average S&P stock lost 9 cents per share, which had never happened before. And of course, we all know what happened to the stock market. It dropped 57%. Now, what you can conclude from that is that, obviously, earnings lead the market. If the earnings are going up, the market's going to go up long term. If the earnings are declining, the market can't go up, not in a sustainable way. Because over time, stock prices follow earnings. Now, what you can see that currently, the earnings are $30.50, at least at the end of the last quarter, which is an all-time high again. Now, that is interesting, and that's very positive, and that would support the higher stock prices than they were prior to the financial crisis. But what I think is really interesting is look how quickly the market came back, or look how quickly the earnings came back for these companies. It was astounding how quickly companies were able to reestablish earnings. And that's the reason why the stock market came back. It's not just out of thin air, it's because the earnings were there. And here, and just to put a little fancy arrow on it, there you can see. Now, let's take a look and see how companies are generating those earnings. This is a nice little graph, and it shows there's basically three different ways that companies generate profits. One is the share count. If they can reduce the outstanding shares, and they have the same earnings, then the earnings per share goes up. And of course, the way they increase the share count is by buying back shares. So that's one way they can increase the earnings per share. The other way is grow their revenue, which that means, increase their sales. And then the third way is margin or cutting costs. And the gray bar, that shows cutting costs. And you can see that right after the financial crisis, what most companies did was focus on cutting back. They cut jobs, they cut investment, they sold off plant, and they really tried to retrench so that they could make a profit. Whereas increasing sales was less important at that time. But now, what we can see is that increasing sales are a more important, relative to cutting costs, increasing sales is a lot more important than cutting costs. And the reason for that is because it's very easy to cut cost. But we can see that right after the recession, basically companies have cut all the costs that they can out of their operating expenses. And right now, if companies want to grow their assets, if they want to grow their revenue and their earnings, they're going to have to expand. Now that's a very good thing, because as companies, when companies are cutting costs, of course, the first people who get hurt are the employees. When companies are expanding, the first people who benefit are the employees. So that's a good omen for our economy as a whole. Let's go to the next slide. This is very interesting. The first top left quadrant, it shows corporate cash, and American companies in this S&P 500 are sitting on over $1 trillion of cash. Now, that's a lot of money. And on the one hand, it's very good because it means that companies are solvent, which is a very important thing. But it's also a negative because it's a drag on earnings. If you took $1 trillion and put it all in cash, in money market, you wouldn't earn very much, and that would be a problem. So corporations have to grow their earnings if they want those stock prices to go up, and they're not going to do it with that cash in the bank. So what's good about this is the bottom line is that they have the cash and they're really forced to start investing it. The payout dividend ratio, that's dividends to shareholders. has been steadily increasing, and that's a good thing to help stock prices go up. We'll look at that a little further in a second. Corporations are absolutely growing. We can see that companies are spending money and they're buying other companies. The gray is spending on buying other companies, and the blue is on investing and expanding. So those are very good things because companies are very keenly interested in growing, and we can see it really picking up toward the end of 13 into 14. So that's a good thing. Then, when we look at a little deeper into cash buybacks and dividends, both of those are increasing. So altogether, when you look at everything altogether, you can see that all of these, the corporate cash, the dividends, and the stock buybacks, and the growth, those are very good things for American corporations, and also very good things, very positive omen for those share prices. Now, let's look at the labor market. During the recession, we lost 8.8 million jobs, and during the recovery, we've gained about 25% more jobs than we lost. We had 10.9 million jobs. And that's a very good thing. Even last year, we hadn't even made up for all the jobs lost, but we quickly made it up in the last year. And what I think is even more important, and more encouraging at least, is that the jobs aren't coming from expanded government payrolls. This is important for everybody except for government employees, of course. Because when the government just expands and hires more people, what that means is basically, the taxpayers have got to pay for it. And the reason that the government invested those trillions of dollars in the stimulus was to get companies to expand and hire and invest. And we can see that they're doing it. The job growth is coming in the private sector, not in the government. So that's a healthy sign for the economy and the stock market. The participation rate is low. That's out of 100 people, how many people are working? And some people lament that and think, that means that people have given up looking for work. Well, it's really not true. The reason that the participation rate is low is because we're aging. We have the baby boomers who are leaving the labor market and they're retiring. And the reason I can say that with good sense of surety is if we look at the ratio of unemployed to job openings. Back during the recession, there was a high unemployment for every job that was opening. But down here now, there are very few there are very few people looking for work to fill the jobs that are available. So that's a very good thing if you're in the labor market, and that would indicate that things are only going to look better for workers unless something dramatically changes. But as things stand, it's a very positive situation for the labor market. Now, we looked at the joblessness rate at 5.6%, down from 10% during the financial crisis. And by the way, do you know what full employment is considered? When the economy has 5% unemployment, that's considered full employment. So we're very close to full employment, which is very good. We've already talked about the participation rate being low. What we haven't really looked at is the average hourly earnings, and those have been stubbornly low. They have not climbed for years, and that's not good both for the employees, the people who are working, and it's also not great for the economy, because if people don't have more money, they can't spend it. However, I believe that wages are probably on their way up. And the reason I say that is because it's very hard for employers right now to find qualified people to take the jobs. And as a result of that, they're going to have to pay more to get people to work for them. Okay. How has that impacted consumers? Well, we can see that our consumer, the average American, our net worth is much higher than it was even before the financial crisis. And our payments to cover our debts are very low, mostly because interest rates are so low. So the consumer is in a very, very good position right now. Let's take a little closer look at the balance sheet of the average consumer. We can see down here that our liabilities are just a small fraction of our net worth. And of all our debts, 68% of our debt is mortgage debt. And the good news is that 75% of all our mortgages are fixed rate mortgages. And why that's important is that even if interest rates were to climb, most consumers would not be in a rough situation because their interest costs wouldn't go up. So that makes, consumers more stable. It makes them feel more comfortable. And it also helps real estate stay stable as well. Now, we can see that at a low during the financial crisis, our net worth went down, or our assets went down to 67 trillion. Before the financial crisis, we were at 82 trillion, and now we're at 95 trillion. So America's wealth has really expanded, and again, that's mostly a result of the expanding real estate and stock market valuations. Let's take a look, see how the banks are doing. Well, the banks are a very important element in the economy. If you don't have strong banks, it's going to be very hard for them to loan out and to basically invest in our economy. But we can see that the equity as a percentage of total assets is doing quite well. As a matter of fact, it's better now than it has been in 70 years. Our loan growth, banks are continuing to loan more money out, both for real estate loans and business loans, and that's good. That makes real estate more affordable, and it also means businesses have got money to expand with. Although business doesn't really, as we saw earlier, they don't really need a lot of cash. They got $1 trillion laying around and nothing to do with it. They're looking for something to do with it. Also, delinquency rates have been declining. Last year, we had a problem with delinquency rates with residential mortgages, but now they're still higher than we'd like them to be, but they're definitely moving in the right direction. So that helps banks become more stable and more willing to make other investments. Now, what's most important, if you ask me, is that the standards by which banks use to make loans is still very, very high. It used to be that all you had to do was fog a mirror and you could get a loan, but that's not the case, and the standards have come down a little bit since the financial crisis, but they're still quite high. Okay, so we've looked at banks. They're doing fine. Let's take a look at real estate. Well, real estate prices have really recovered significantly. It looks like they're slowing down a little bit right now, but we don't think that prices are headed in a negative direction. Obviously, it could be wrong. There's no way to make a forecast with ironclad certainty. But things are slowing, but still, and the reason I say that probably real estate is not going to fall off a cliff, well, number one, affordability. Housing is still very, very affordable, and largely because interest rates are so low. And also, home inventories are still very low. So home inventories have increased and expanded, but they're still very, very low. And as a result of that, we don't think that real estate is in a bubble. It will continue to slow, but there still should be appreciation so long as interest rates remain low. Now, we've looked at consumers, we've looked at banks, we've looked at real estate and corporations. How's the government doing? Believe it or not, it's not doing as badly as you might think. We're still borrowing 13 cents for every dollar that we spend, which is very high, and we're still running a deficit. But if you look you can see that our deficits have really come down since the financial crisis, and they're supposed to continue to decline through the end of the decade. Now, I'll tell you in a few minutes why I think that, this forecasts that deficits are supposed to actually increase after the close of this decade. I'm not sure that's the case. I think there's a possibility that they will continue to decline, and we might even run into a situation of surplus. I'll tell you why in a minute. It's not a guarantee, but it's a possibility. Let's look at our net debt. We can see that we owe a ton of money, over $18 trillion. And it's a lot of money. And it's supposed to even expand a little bit, but it's slowed down quite a bit. I mean, the growth of the national debt has slowed significantly here. But what's interesting, I think, is that while the debt is unprecedented, we're still lower than where we were relative to our GDP back shortly after World War II. So the reason that I think this is very important is, well, back in World War II, or after World War II, we were able, over a period of 20, 30 years, to take a big dent out of our national debt. Now, there's no guarantee that we'll be able to do it again. Absolutely not. But I think we do have the opportunity, and I'll show you where. I believe that we have a huge opportunity when it comes to energy. In the last 10 years, we've reduced our energy imports by 50%, which is staggering. And obviously, we've seen oil prices come down from $115 a barrel down to $46 a barrel. And that puts an extra $1,200 a year into the pockets of American consumers. And that's a huge tax decrease for most people. And that's money that people will spend, and that will be used to further stimulate the economy. And as the economy is stimulated, that's going to generate a lot of tax revenue. Now, I'm obviously not convinced that the government is going to use that to pay down the debt, but I think it's a possibility. And if the elected officials don't do it, then vote for Neil. That's all I can tell you. Now, the increase in our independence, in American energy independence, does a lot more than just put dollars in our pockets and in the government's coffers. It also helps us negotiate with other countries, like Russia and with Iran and other rogue states that may be up to mischief that we're not really crazy about, but we couldn't really do much about it in the past. Now we have a little more wiggle room when it comes to negotiating with other countries around the world, because they don't have us over a barrel, literally and figuratively, as they used to. So let's take a closer look for a minute at oil. I think it bears a few more minutes. So many people look at the reduction in oil prices and they say, well, look, oil dropped from 115 to 46. It must be because the world is slowing down and the economies of the world are slowing down and there's less demand. Well, actually, the reason that oil prices have dropped is because, this is astounding, the United States has increased our production by almost 21% in a very, very short period of time. Since 2013, which is a year and a half ago, or a year and a few months, we've increased our production by 20%, which is really phenomenal. Now, in terms of consumption, our energy use has gone up a little bit. Europe has declined a little bit. Japan has really decreased their oil consumption, but China has increased their consumption. And if you look at the global situation, global use of oil has gone up by 2%. So to say that everyone is slowing down and the world is in a recession, it doesn't really make sense, because people are still using energy. Our energy usage has gone up, the consumption has not increased as quickly as people would have thought, and that's why some people are in a panic about it. But in my opinion, it's not a question of why prices have dropped so much. It's more a question of why prices were as high as they were for so long. They were artificial because the market expected consumption to go way up and supply to stay the same. What we've seen is here that that supply has gone up significantly, and that's the reason why we've seen prices go down so much. Now, some people are concerned about interest rates, and certainly it makes sense to take a look at that. If interest rates go up, generally speaking, the stock market is supposed to go down, but again, you want to have perspective. Historically, when interest rates were below 5%, that's what this line represents. When interest rates were below 5% and the interest rates climbed, the stock market actually went up in most cases. Now, when interest rates were above 5% and interest rates increased, we see that the stock market had a problem. So there's obviously, again, no guarantee, but it seems to indicate that we may have a ways to go before with interest rates, before we have to really worry about its impact on the stock market. This chart shows the history of the stock market since the beginning of the last century. And we can see that we have almost like a step stool, where from 1900 to 1924 the market didn't do much, then it shot up, and then it shot down, then it recovered, then it had another step stool, then it went up, then it didn't do anything for a good 8 years, and then it climbed significantly. And since 2000, the market hasn't done too much. But we can see that now it's sort of above the line. Does that mean the market for sure is going to go up from here? No, it doesn't. But again, since 2000, the market hasn't done a whole lot. But that's sort of the way it goes. It goes up and down and doesn't really move forward big time for a while, and then it has a big growth spurt. That's what's happened in the past. So it's possible that we're on the cusp of this happening again. It's obviously no guarantee. Now, let's take a closer look at again, to get some perspective. J.P. Morgan has put this chart together, and it shows us in any one year, over the last 60 years, or 64 years, the worst market was a drop of 37%, and the best was an up 51%. So in any one year, no one really knows how good or bad the situation can be. But if you look out for a 5-year horizon, you can see that the worst 5-year experience was a negative 2%, and the best 5-year average was up 28%. And if you invested 50% in bonds and 50% in stocks, you can see that basically, historically, you've never lost money. Now, that's not a guarantee of the future, of course, but it gives you some perspective, and it's important to always have that perspective so you make the right decision. Now, is it possible for someone who's retired and who's taking money out of their account to have a 5-year perspective? Well, let me put it this way. I think it's crucial that people who are retired have a 5-year investment horizon, because if you want to stay retired for at least 5 years, you want your money to last. It's not so much what your age is, it's how long you want your money to last you. So if you want your money to last you 5 years, 10 years, 20 years, 30 years or more, we can see from this chart up here that it really makes sense to have stocks at least as a percentage, as a portion of your assets, because the growth is much better. Now, obviously, again, it's no guarantee of the future, but you got to think long term, because you want to, if you're planning on living for longer than 5 years, it makes sense to do so. And, the way that you can stay solvent and not poor is to continue to grow your money a little bit, at least, to offset inflation. And we're going to need stocks to do that. Obviously, there's more risk to it, but it makes sense for at least a portion of your assets. Okay. So let's have a summary. Let's summarize what we've looked at so far. The U.S. market, while it looks pretty strong, it looks a little bit ahead of itself to me. And as I mentioned, that's a caution. That's a cautionary tone for me. So, as I said, I think that in order to really see stock prices move up, we're going to have to see, in a sustainable manner, we're going to have to see the earnings go up as well. When it comes to earnings, it actually, the situation looks pretty good. Corporations have a lot of cash on their hands. They're investing it. They're growing it. They're not cutting costs. They're paying out dividends, and they're buying back shares. So I think it's reasonable to expect, all things being equal, that corporation earnings will increase. How quickly, no one knows, but I think they're going in the right direction. With respect to consumers, they're doing quite well. They got more wealth than they've ever had. Our debt payments are relatively very, very low. It's easy to find work. And we should expect wages to increase in the in the foreseeable future. So those two elements are strong. With respect to the government's doing better than we thought. We're still running deficits, and that's not a positive sign. But our deficits are declining, and we have a real opportunity with this windfall of oil and shale to use that money to pay down some of our accumulated debt. Whether or not that will happen, I don't know, but it is an opportunity. So the economy is strong because you've got a government that's at least spending less money. The jobs are not coming from government and taxpayers, but from the private individuals. Corporations and consumers are doing well. Real estate looks like it's stable to climbing. Banks are in a good position. Interest rates could go up, but it probably won't sink the market. Again, it's no guarantee of the future, but it looks pretty good. What about Europe and Asia? Some people look to Europe and Asia as real trouble spots, and there is some trouble, but let's take a look at this a little bit closer. When we talk about Asia, really we're looking at Japan and China. And China has slowed down from double-digit growth to single-digit growth. They went from, I think, 11 or 12% down to a 6% growth. But 6% growth is twice the growth that's happening in the United States. So China is growing still very, very quickly, but not as quickly as the expectations were. And that's why the stock markets there have been a little unsteady. Japan has been stuck in a deflationary period for over 25 years. But very recently, they've been able to turn that around. Now, I don't know if it's sustainable, but they actually saw an increase in prices, and that's a very, very positive thing for Japan. Now, prices didn't go up as much as they didn't have the growth that they really wanted. It was about 1%. They were looking for 1.7. But nonetheless, they're headed in the right direction, and there's a good turnaround for the future. When it comes to Europe, there are problems. Across the board, there's 11% unemployment, but the southern European countries have a lot more problems than the northern European countries. The southern European countries have higher unemployment, they have high interest costs, and they have a lot of accumulated debt, whereas the north has less of a problem. Recently, they've announced, the European Union has announced that this week, as a matter of fact, they announced that they're going to be investing $1.3 trillion to stimulate their economy. In the United States, we had a stimulus of about $2.5 trillion. So some people say it's not enough. Some people say they shouldn't do it. But at least in the United States, since that time, while it has caused us to mushroom our debt, it has helped revitalize our economy. And with Europe, who knows if that will work as well? We don't know. But just as a year ago, I didn't know, and I don't know that many people here knew, that the price of oil was going to decline from $115 a barrel down to 45. Surprises happen, and it's very possible that we could have a turnaround story in Europe and Asia, and that right now the United States market is the strongest for investors, but it could very well be that Europe and Asia do quite well in 2015. I don't know, but it certainly bears watching. It's important. So, what is the best strategy going forward for you? There's so many variables that we just don't, it's hard to predict. And as you know, I don't try to predict the market. My goal is to help you grow your money so you don't have to worry about it. So what we have to do is, first of all, make sure that we understand what your needs are. Because even though we can't control the stock market, what we can do is we can control how we invest in it. So that's why, sometimes you'll need more growth, sometimes you'll need more income. And this is why it's so important for us to talk and for us to connect. So whenever you have a change of situation, I really want to know about it. Next is we want to be aware of what the alternatives are. Even though I'm a certified financial planner and a money manager, I make money as I manage more assets. That doesn't matter because I'm a fiduciary and I have a fiduciary responsibility to you. And what that means is it doesn't matter if it's the stock market or buying more real estate or paying off a mortgage, even though I don't sell real estate and I don't do mortgages. It has nothing to do with me. I have no financial incentive, but if it's in your best interest not to invest, I'll tell you. And we want to look at all the alternatives before we make out a plan. And then finally, we want to have vigilance. We want to be vigilant about what we're doing for you. And again, as your needs change, we want to make sure that we're updating your financial plan. On top of that, obviously, we need to be vigilant about the investment world, not only the stock market, but real estate market and other opportunities as well. Because, like I said, there's a lot of alternatives, and we need to make sure that we understand how they're working right now and what the opportunities and risks are. So I want to give you, before we close, I want to give you an update of what's happening at Wealth Resources Group in this year and what my game plan is for this year. Number one, obviously, continue to pay attention to you and the investment markets. Number two, continue to have a flat hierarchy. As you know, Joey Agdanawi is my operations manager, and I take care of the financial planning and the investment management. But if you need me for anything, you want to talk to me, no one's going to stop that from happening. So the main goal is taking care of you as quickly as possible, and if you need me, I'm there. Just let me know. Number three, we have a 15-point quality control check system. This is important. I spend thousands of dollars every year, and we spend a lot of hours too, making sure that as little as possible falls through the cracks. We just don't have that many mistakes. We spend a lot of time, and we have more sophisticated programs than firms that are much bigger, because I don't want to have an oops moment. So we make sure that all your service items are handled. We have 3 people that look over every single service item just to make sure that things are handled as well as possible and as quickly as possible. And if you see something that needs to be improved, if you've got a question or even a criticism, I definitely want to hear about it. Just let me know. Most of the clients that are sitting here are referred by somebody else. And that's important because it gives me, obviously, increased motivation to deliver to you. I don't need to spend a lot of my time looking for new clients because you're helping me grow my business so I can focus on you. So it's a benefit to you, and I'm going to redouble my efforts to focus on you. And again, I want to invite you, let me know if there's anything I can do to make your experience with Wealth Resources Group even better. Almost everyone who's with us stays with us. And that, I think, is the ultimate compliment to what Joey and Rena and Kim and I are doing. And we really appreciate it, and we're going to continue to work hard to continue to earn your business. This year I'm going to continue writing. I write for my own blog, and I also write for the Huffington Post and Business Insider and Forbes. And that's important because it forces me to stay informed. When I write, it forces me to do a lot of research and stay up on what's happening, so that helps you in return. And then finally, the most important statistic as far as I'm concerned is that 98% of the clients who want to stay retired, stay retired. As I said, our mission is no money worries, no matter what. And I always think about that mission before every day that I start to work, and so does Joey. So we have a total commitment to you. Let us know how we can improve, what we've overlooked, or even if you like something, let us know about that too. We can always appreciate that because you're number one in our book. So thank you very much. We're going to continue to pay attention to you. That's how we're going to continue to deliver our very best as possible. So again, thank you very much. I appreciate you tuning in. And please contact me. You can see my email down here. If you've got any questions, I'd be delighted to hear from you. Thanks. For more great ideas on how to have no money worries no matter what, come on over to wealthpilgrim.com, sign up for your free weekly updates, and get a free e-course on how to make better investments.